Hello, welcome to the Critical Point Podcast. This particular show is on cotton, and it is May 7th. This is Rich Pazin, CMT. Let's take a look at the fundamental side here. We're looking at the PSD online site by USDA. We're looking at world cotton numbers. And let's scroll down here, and as we can see, the overall yield for decades has been rising. However, in recent years, we've seen a little setback and the world yield of cotton. Let's move on to something along the lines of how many hectares were harvested throughout the world. And we can see we've recently got a spike up. We can see it's rather stable, but on the high end of historical range, which should be a concern that we have strong production. So let's swing over to world production. And indeed, we're at historical highs for world production. Now, the model will work at various fluctuations, like it's saying there's starting to be a 60 to maybe 70% chance for a little setback of cotton here in the next year or two. So we'll want to watch out for that. I don't know if that could be economically related, since the world is upside down right now and inside out in terms of economics. Or do we have an upcoming crop problem? And I am forecasting a crop problem for the U.S. At any rate, let's move on to the stocks to use. A lot of people like to use this as a way of just simplifying the fundamentals. And we got a big surge in the world of stocks to use. Now, I didn't check to see if this is the data without China. I'm assuming it's probably got China in it. And they just have supplies that they're never really going to cut back. So I'm not so sure that high of a stocks to use ratio is something to be, I don't know if it's bearish as it seems. Now what we want to do is flip over to the US. And here's the US stocks to use. You can see it is rising, okay? We're producing more than, say, demand, or you can argue maybe demand's backing off a little bit. We had the trade war issue with China, of course, and now, of course, we have all this economic issues and problems here. You can see in the past, though, we had some very high stocks to use ratios. So for the moment, this is kind of normal range, but the problem is I think most people would just look back over the last 10 years and say, uh-oh, it's rising, and that would get them to think a little bit bearish, or at least reduce their optimism on the bull side. And if we take a look at harvested acres, we can see we're growing more cotton. And I think it's kind of understandable what's been going on in the corn market and what had been in the wheat market. Wheat has improved price-wise, but primarily corn is probably holding back those southern growers, saying they might just as well grow cotton. And then, of course, if we look at our exports here, we saw a big surge, and now it's kind of leveled off, but it's still rather strong. I like it, okay? But the problem is we're trying to make sure we keep the production up to match that, right? So now let's take a look at the long term in terms of prices, and this is a continuous chart, monthly chart of the cotton futures. And we can see the market put a 9-year business cycle bottom back in 2008, 2009. So it kind of coincided with the bottom of the Great Recession in the U.S. And then we got a ballistic bull market. It was like a rocket ship going into 2011. And that was actually a 9-year cycle top. And you see this quite often for commodities. We get a big bull market, and then we get a lengthy bear market, just a kind of a slow death kind of scenario, okay? We put prices so high so fast that it starts to hurt demand, but also buys more production. And farmers really need to learn, when you get these big bull markets, the market is not begging you to grow more. It's simply saying what we have is worth a lot more, okay? And so you really need to be cautious. I think economists kind of fail in this regards of helping agriculture, helping farmers specifically, to deciding whether they produce more or not, okay? In my opinion, these big bull markets should be windfalls, and one should be paying down debt. One should be investing in other businesses than farming. One should be put in the stock market, earn better returns than they probably can earn in farming, that kind of things, okay? And that way you build capital so that once you get into these major bear markets, you can start withdrawing money from the stock market. You can sell those other businesses, or maybe you have more leverage, add more leverage, meaning borrow more, then you can expand production. What you really need to do is be able to prove that demand has risen for 5 years and prices have risen 5 years. Then you can start talking to me about the market wants you to plant more. And I haven't seen that in my lifetime, I don't think. So it takes quite a bit to make me think, yeah, you got to plant more. Okay. But granted, when you look at the very long-term scenarios that the global population is going to continue to grow and the economy is going to grow, we do have to consider, yeah, the world needs to produce more over a long period of time. All right. So the point is, it's time for a 9-year business cycle bottom, and I can't quite tell whether it's really occurring now, or is this going to take all the way into early next year, which should be the latest probably for it to bottom. In addition, we got a problem that inside the 9-year cycle, we have 3-year cycle bull and bear markets. And so this was also a 3-year cycle bear market that coincided with a 9-year. So it was greater bullish fundamentals we would normally expect for a 3-year, then greater bearish than we would normally expect. Then this gets into your standard 3-year cycle by itself, okay? Supply and demand. Now, the point is, it should be rallying into a 3-year cycle top. And what I'm concerned is if it rallies into a 3-year cycle top right after a 9-year cycle top, then we could be range bound, or I should say the market could be range bound for years, okay? That kind of takes away the upside because this next 3-year cycle top could be a 9-year, meaning we ought to get maybe not something as explosive as this. It may only be a third of this, but we ought to get some kind of bull market going on here, okay? And so we'll have to assess that over time. But that's my long-term scenario, is we do have some upcoming possibilities, but how bullish? So for the moment, what I'm doing is dialing and saying, well, this should be extreme support. The market's undervalued. Someday we're going to work our way out of this virus-related recession, if not depression. And we're going to move on up. And so to me, I would just dial in a trading range of really 56 on up to into the 80s. And we're just going to have to wait a while to see, are we actually going to get a crop problem? Because cyclically in the Midwest, we're due for problems for corn, wheat, soybeans, 2021 to 2024. Those are the years. That's the range. Can't tell you what year it's going to be. We might even have 2 years out of that in that range of crop problems. They could be consecutive. They could be broken up with a good crop in between. And I'm wondering, what does this imply for the rest of the world? There could be other regions that are due for a crop problem as well. And I tend to think maybe cotton doesn't really coincide with Midwest, but it could be like a year ahead of it, and maybe even a year behind that range, okay? And when I'm not really finding a lot of evidence that cotton gets the crop problems like some of the other commodities. So that's a bit of a complication there as well. But anyways, that's the long-term scenarios. I fully get why this market is getting undervalued here on a long-term basis, why we're due for a bull market, but I'm a little concerned it might just be range-bound for a very long time. All we're doing is establishing a new floor, and it's time for some kind of rebound, okay? So we'll monitor this, see if we can come up with something. I'd really like to see maybe a 3-year cycle top just ahead of a 9-year cycle top. And then that could open the door where we could get a 2 to 3 year rise. And then there would probably be 6 months out of that rise when we actually get a serious bull market. And hopefully we can get something back above the $1 mark. Okay, let's swing into some of the smaller trends inside for trading. Okay, so here's the weekly chart of the July futures. So I switched from the continuous because in the end we all buy and sell individual contracts. And when you finalize your analysis, even if you're looking long term, you really need to convert it to individual contracts because sometimes it tells you something a little bit different than that continuous chart. So here we have the July futures. And what we have are the level 1, level 2 trends that we see in all markets, okay? And they are the most important kind of trends during the year. And when you're looking for long-term tops and bottoms, you need a level 1 to coincide with it. So here's our level 1 bottom. So maybe we just placed a long-term bottom in cotton. Don't know. We still need a lot more data, and it's going to take some time to figure that out, okay? But from a trading perspective, at least, we got a level 1 bottom. And even though I say the market should actually set back for a while and consolidate, I'm not convinced the country is ready to get back on board here with a strong economy. But the problem is the market has actually stayed up a little bit longer. It should have topped right here in early April for a level 2 top. The latest Technically, it paid no attention to that idea. The market didn't pay any attention to it. It simply did not work. And if this is correct, then this market is actually going to try to work higher into June for a more important level 2 top. And my guess is we will get a setback here by July, August. Okay. So it looks like it wants to rebound. It wants to recover from this scare and this damage done by the virus recession. Okay. Now, we have a weekly stochastic indicator that's actually bullish, but it's also approaching overbought. So it makes me wonder how well will this forecast work of staying higher into June. Okay. Now, it can go further into the overbought area. It can roll over even as prices go higher. And if we look at the number of weeks here, really, it's feasible. Okay. Is it plausible? I don't know. Okay. What's really going on in the day-to-day fundamentals here? I'm a little bit behind on that. Looks a little cloudy to me. Okay. I guess what I'm concerned is there's still headwinds coming from this virus-related recession for the U.S. and the world. And I think there's more bad data coming for the world and the U.S. But at the same time, some of these markets act like they've already dialed it in. Okay. And at some point, we're going to get back to work. And the economy is going to improve. And we're going to see better demand. Even if we don't get better demand and moving the needle on the S&D sheet, the balance sheet, we can see better buyer interest, meaning it's the same amount flowing through the pipeline, but they pay more for it, okay? At any rate, until we see trade below this week's low, 53.2, more so on, say, 2 to 3 daily closes, even more so on a weekly close, then I think I want to give the bulls a chance to work cotton a little bit higher here. And we may yet see them attack 60 to a little above 60 cents here. I don't have a lot of upside objectives. It looks like the critical point objective probably would point to this little hesitation part here where it was a little brief support. So maybe the low 60 cent area. Okay. If it does violate this week's low, especially on a closing week basis, then we may see this level 1 not work, and we want to concentrate more on a level 2 top, and we may see a revisit of near 50 cents, if not even lower. So the bulls really need to make sure they hold this support this week. Not a lot of great insight here for you. I'm willing to give the bulls a chance. I can see where the model's just a little off and it just peaked a little later than expected and it's going down the next few weeks. And I am concerned the stock market going down the next few weeks. We may get some poor data again. But yet I'm looking at some of these commodities, and as long as we can keep crude oil kind of stable, we can keep a few other things that are going on and around the world and commodities a little bit stable. It just looks like to me there's a chance cotton wants to stride towards 60 cents. As always, manage your risk relative to analysis of others. Thank you.